You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Cem Karsan and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to some of the past episodes that you may have missed, like my conversation with Rich last week, where we laid out the key reasons why the specific correlation profile that trend following offers investors is really unique. And if we only say we are non-correlated, we are in fact not really doing ourselves justice. There is more to the reason that trend following can not only enhance the returns of traditional portfolios, but also at the same time reduce the risk of the portfolio. And it's all explained in our conversation last week. Also, I would encourage you to listen to the midweek episode where I had the pleasure of speaking to Simon Hunt, who has spent decades in the copper industry and spent a ton of time in China. So he has a unique perspective on markets and geopolitics, and he combines this with technical and cycle analysis, and his forecasts are some ways away from the mainstream Wall Street consensus, and I think you really need to hear him out on that. Anyway, go and check them out after you listen to Cem and I today. Cem, it's good to have you back on the Systematic Investor Series. How are you doing today?
Good.
It's
always great to be here.
Weekend.
Yeah, absolutely. No, I always enjoy these conversations.
Yeah, no, absolutely. We have a great lineup of topics. We have some questions that came in via Twitter. Before we dive into all of that, let me just give you a few headlines for the week. Actually, the week, there was a lot of officials from the Fed out speaking, including the St. Louis president, James Bullard, who upped his view on where the Fed funds should be, now to between 5 and 5.25%. And that's up from 4.75% to 5% previously, stressing this is a minimal level. Bullard has been one of the more hawkish members, we have to say, on the FOMC, and given the direction of policy this year, has also been one of the more influential members. However, the Fed might start to face more resistance from the divided Congress, with Democrats warning about job losses, while Republicans continue to stress the importance of price stability. But yields did go down this week, and U.S. home buyers got some rare good news yesterday, as mortgage rates saw the biggest decline, weekly decline, I should say, for 41 years. The drop, which saw the average rate for 30-year fixed mortgage fall to 6.61% from last week's 7.08%. Interest rates expectations are certainly driving a lot of the market cycles right now, maybe with the exception of the crypto space, where SBF seem to be doing all of that. But from memory, I seem to think that often markets are often very volatile around this time of the year. And speaking about volatility, the London Metal Exchange, or LME, is hiking initial margin by 28% on nickel, which the exchange has targeted for heightening monitoring due to heavy volatility in recent days, where the exchange came out saying that it would undertake enhanced monitoring of nickel after it fell as much as 15%, having already breached the LME's 15% daily limit price swing on Monday. And I think many of us will remember what happened earlier this year with the LME and nickel. All right, let me bring you in here, Cem, just to maybe touch on some of the things sort of high level that's caught your attention since we last spoke, either in terms of markets, volatility.
Yeah, I think the biggest takeaways, and you mentioned some of these, are, at least here from stateside, the U.S. elections, significant outperformance by Democrats in a midterm cycle where they win the Senate, and just close in the House. I do think that is important. A lot of people kind of would maybe mention that it's still split Congress, et cetera. I do think there's importance to that. I think we'll get to that later in the show a bit. Obviously, CPI coming in weak was a huge, kicked off a massive rally, biggest one-day rally of the year, which was fairly enormous given some of the moves we've already had this year. I think we'll dive into that and what that might mean and how that fits into the broad kind of inflationary landscape. And then, I think those are the two biggest takeaways. Obviously, we're heading into the holiday season. Some of the seasonality, et cetera, I think is important to look at and not just from a magical construct. Again, thinking about what is driving some of the seasonality, what does historically, and how does that fit into now? How is this time maybe different or the same? So those are the main things in terms of events and things we've looked at. Obviously, there's some structural things that we'll talk about too in the vol markets and broadly, where we see those things right now.
Absolutely. And I think in fairness, I think it's worth mentioning that last time we talked about this, you kind of teed up some of these surprises that could come into the markets very well. So it's definitely worth paying attention to this. From a trend following perspective, it was another correction week with many of the bigger trends like fixed income, currencies, energies moving against the bigger trends and inflicting some pain on trend following positions. This is, of course, as it should be. Trends don't move in a straight line. And in fact, I discussed with Rich a few weeks ago that trends can in fact look very different from each other, which is why you need to give them a bit of space to move around. For the month of November, overall, as far as I can tell, very few markets have provided positive contributions so far, but we still have a couple of weeks to go, so a lot of things can happen from here. My trend barometer continues to be pretty weak. Yesterday it closed at 23, which is a very weak level, so kind of teeing up with the performance that we see. And speaking of performance, and this is as of Wednesday because we're recording a day early, the Beta 50 index down 4.1% so far this month, still up 15 for the year. SocGen CTA index down 4.5, still up 21 for the year. SocGen Trend down about 5, still up 29 for the year. And the SocGen Short-Term Traders Index down 0.75%, still up 11.75%. So far this month, the MSCI World is up 3.75 thereabouts, still down 18.25 for the year. World government bonds having a good month, up 1.44%, and the S&P 500 down almost 2% as of yesterday, up 2% as of yesterday, down 17% or so for the year. Now, let's dive into a few questions. Most of them came in via Twitter when they found out that you were coming on, Cem. Of course, we always get lots of questions. That's great. We appreciate it. But we did have a question in that came in a little bit earlier, and this is from Dave. And Dave just asked, I would like to ask Cem what he thinks about this inverted yield curve and why it's not being covered in the press, and are they trying to hide it? Or does it not matter any longer? Another question for Cem is where he would keep his money to protect his spending power. And maybe the question should be more related to whether or not precious metals are a good place to protect the value. Any thoughts for Dave there?
Yeah, absolutely. And I think we'll walk through some of these as we kind of talk bigger picture. But, I've talked about this for some time. There's a big difference between cyclical and secular inflation. We've lived in a world now for 40 years where they've been one and the same. That all that has mattered is the short-term cyclical effects, because we've been in one secular trend of disinflation, and that's led to monetary policy dominance. So I won't rehash that whole conversation, but I think it's important to note that everybody who's traded the bond market pretty much ever, that's currently trading, right, is in every algo that's probably been written that's really looking at how things work, focuses on cyclical effects. And the cyclical effects, and this has been the case, the curve's been inverted, mind you, from a lot lower in the 10-year. And so you've been getting a credit to have the duration effects of yields going higher, and that's been an awesome trade. We've been talking about that for some time. That doesn't mean necessarily that yields are too high. It just means that that's what the bond market thinks, and the bond market's been very wrong for over a year now, and in lots of different ways. And so I think there's reason to believe that the secular effects, so long-term yields are still low. And short term, but in the short term, that over the next year or 6 months, really, that cyclically we're going to get a little bit of disinflation in a more secular inflationary period, and we can get into that later in the show. But I think I think that inversion of the curve, this is a little bit different. If you look at yield inversion, the yield curve inversion, it takes all periods, inflationary and non-inflationary. And the inflationary periods are a bit different in how, what that means. Yes, it can still mean recession, but that doesn't mean disinflation necessarily. We can look at the 70s and talk through that. You can be in a stagflationary environment, right, where you still have significant longer-term increasing inflation in the context of a recession. And I think very few people are really putting those two things together. It's always recession, non-recession. Where are we what's happening? But we could have both, and I think the bond market's getting that part wrong, in my opinion. Now, to the second part of the question, how do you protect against secular inflation, right? Obviously, gold hasn't worked as well. A lot of people are kind of scratching their heads. Again, I'll get into this a little bit more. We've done some work on gold and how it tends to work. And we do still believe precious metals will do very well. And in particularly, think there's a significant opportunity to upside long dated calls in gold, especially given how vol has done in other places where it's got a lot higher and where in gold it really hasn't yet. So there's a vol element to this as well as a directional element that can really be an interesting bet, one of the more interesting bets out there in the vol space, if you ask me. But again, we can dive into that a bit later.
We'll dive into all of that. Sure. Okay. All right. The next few questions are probably shorter, and I don't expect you to necessarily have long answers. And also, I'm trying to get used to getting questions via Twitter, because usually they're a little bit shorter, and you have to kind of decipher a little bit what is being asked. But let's go for it. The first one comes from, and also the other thing I find is that, of course, when it comes from Twitter, people have kind of funny names. And the first one is from Eron Musk. And he asks, or she for that matter, would be interesting to hear Cem's analysis on hedge fund redemption dynamics over the next 3 to 6 months. Now, I don't know if you have a view on that, but that's the question.
Hedge funds have been performing quite well, honestly, from a broader viewpoint. I think the broad view, there are definitely parts which we talked about, I think last episode, of the market, particularly long vol, which have been dramatic underperformers relative to what you would hope and expect into this type of a market decline. But broadly, hedge funds have done very well, particularly relative to, equity markets, bond markets, et cetera. And I think that's a secular trend, meaning for the next 10 years, I think I would expect that. Again, passive investment, long-only investment, we've talked about this before, has become so dominant and ingrained in pretty much every corner of the market that there's just been very few successful, active managers, hedge funds. And I think you're going to see a broader move from broad asset management into alternatives broadly. And I include trend and other things in kind of that broad non-correlated investment sphere. So I do think we're seeing a good time for that. So I'm not looking for a bunch of redemptions from the hedge fund space. If anything, I think there's a wall of money that is working its way into that space. And there's, from my experience talking to, some of the biggest, Citadel, Millennium, all the big boys, like, they're not taking it. They're at capacity, and they're having a hard time finding where to put the money. They have no lack of capital or redemptions. It's the opposite. And then there's a launching of a lot of big new funds who are ultimately kind of offshoots of some of those other funds that are coming online and are going to continue to come online. So quite the opposite. They're not worried about redemptions. Again, there is some, as we talked about, relative to the long vol space and what that means in certain corners of the market, and we'll get to that, I'm sure, later in the show.
Yeah, and there's always going to be this recycling of a switch between strategies. That's kind of normal, but I agree with you. Overall, I think the active management area is probably going to do just fine. So, yeah. Well, we appreciate Eron Musk. I was just about to say the wrong name, but Eron Musk is, of course, the name for that question. Anyway, we have a question from John. Would love to hear Cem's update forecast for the next 4 weeks on December Opex.
Yeah, I mean, today is actually Opex for November, so important to note that. These are important periods to kind of give updates. again, we'll dive in. This could be a long one, but we're at the corner of we talked about this about a month ago and really called for this rally for things to chop around early last month, and then eventually with CPI through that CPI week, given the event vol and everything that we had to really see and the season the holidays coming up to really see some rally. So we're a month in now, so important to look around and think, but seasonality is there for a reason. As I mentioned, it exists because of low liquidity during these periods. Time compresses in these periods. Not only do you have more holidays, just volume weighted time. And I know that's a weird concept, but time is not really linear. So, nothing can happen for weeks, and then you can, have a lot happen all of a sudden in a day or two. And that really is a function of liquidity and volume. So given certain dynamics, there is structural support, broadly. And on top of that, you have time passing, which is accelerating some of that support. And you have less liquidity on the other side to absorb that. So those forces can be outweighed. So I would broadly, I think a little bit of sideways action in the very short term. Continued vol compression makes a ton of sense here as we digest. Maybe another little head fake, right, to try and shake people who are trying to play long here in the seasonal period. But broadly, this is a period to be constructive on equities, despite what we think is a still secular downturn in equities that will continue once this period is past.
Yeah. Okay. Cool. Then there's a few sort of quick. Well, I don't know if they're quick, but let's make them quick. Questions from JZone. He's throwing a few things at you. Crude put versus recession. He talks about the 20-day simple moving average and standard deviation up. All that matters is the 20-day SMA and standard deviation up. All that matters for trend followers. Probability of right tail risk that China plays ball. Motivation for national interest versus economic prosperity. Take that how you want, Jim.
There's a lot in there. I'll be real quick with that one. It's it's complicated. You can't just look at the 20-day and 2 standard deviation up, but do Bollinger Bands and broadly technical kind of things, are they great tools? Absolutely. Yeah. I mean, for primarily, using them in a way to measure. Framing everything in standard deviations is I think, important because it gives you a better relative value tool for what flows look like that you don't know. So there are things there are things you understand about what flows are based on, the information you have, but there's always going to be things that you don't know. And in the context of what you know, if you can look at technical things like that, they will give you context for strength and weakness from the things you don't know. And that's how we broadly use those things. I don't know if I answered all those questions, but that's in terms of those types of things. What the one thing I would say, and just broad approach.
Sure. And I will come back to all the more macro points, I think, anyways. But we appreciate the question, JZone. Question from The Slaughter 79. Flows, Opex-deltahedging-gamma-vanna-charm stuff for the rest of the year. I think we've kind of touched on this already, but I do want to just
I think mention that touches on the next 3 to next month of what we're looking at, 4 weeks or so. And I think, again, when I'm talking about flows that are supportive, those vanna-charm flows are definitely what I'm broadly referring to. There are other things as well, but.
Sure. Last question before we dive into all the great topics is a question from Spek. What's the S&P 500 potential bottom, and when possibly could it bottom? My main scenario is minus 50 to minus 60% from the top and bottom at some point in 2024. Very likely we could revisit COVID lows in real liquidation. Now, obviously, that's a big question. Lots of forecasting required. So I'm interested in how you're going to answer this one.
Yeah, prediction. Everybody wants up or down and wants a price target, right? In our view, prediction doesn't work that way. It's not productive to think about it in that way. it's important to think about it as, again, a distribution of probabilities. Things change and change that, bend that distribution. Those probabilities are, I know this sounds complicated, but they're out in different periods of time. And that, think of it as a three-dimensional surface. As an options trader, that's kind of how I would rather think about it. And the realized probabilities are changing. We're not just pulling that from the implied volatility surface. Implied volatility surface is often very, very wrong about these things, but we do look at that as an input to kind of, as well as macro flows, et cetera, to what happens. So that being said, I'll reiterate, believe this to be a secular decline in markets. We do not think we have seen the lows yet. That said, we do believe within that we are in a short-term cyclical positive period. How high can it run before it goes down? It could run a little bit. The Fed's going, in the process of pausing, but they're going to pause, not pivot. It's going to be gradual, and they're not going to want the market to run too much. They are ultimately going to continue to sell calls. Inflation is, one of their two major mandates, and they are, they are not done. And that is kind of the reason, you can have conviction that this thing can only run so far in the short term. And again, as long as we're right about this being a secular inflationary period, which we have some conviction in, even though we're in a cyclical kind of downturn to inflation within the context of that, then we should be, again, we believe that the market will ultimately, given where valuation started, given historical context for what's happening here, at least another 5 to 20%. I know it's a wide range, but that, we can move those in days in this type of a market, depending on what's happening below where the lows were. That said, there are some structural, other things that we believe, unless we get broad stress and liquidation, meaning, really something, another level like China and the U.S., like again, an invasion of Taiwan, some real, something that's going to bifurcate the world economy, which could happen. But unless we see that, we do see that there are opportunities and there's enough money floating around that there will be, we're not going to see it. We don't think at this point, again, unless we see one of those things, a 2008 type scenario, we think it will be a much more contained decline.
Okay. And all I would say before we dive into the topics, just to further answer you, Spek, for this question, if you want someone who is not afraid of giving some really outside the box answers about that, it is exactly the episode we released on Wednesday with Simon Hunt. He gives you both, some dates, or I should say time periods, and some pretty big scenarios, both for equities, currencies, interest rates, the whole thing. So feel free to dive into that episode. All right, Cem, we've got some topics, and again, I think it'll be a pretty sort of, we're going to pay it a little bit by ear today. And so I'm going to spur you up with some things that we talked about, and then we'll see how we go. But of course, since we last spoke, we've had a US election. We've had, as you mentioned earlier, we've had somewhat unexpected, or better than expected, I should say, CPI numbers. They were not unexpected for some. And that obviously has an impact, including on volatility. It certainly has had an impact on many markets from a trend following perspective. But how do you see, and what is the importance of these outcomes we've had?
Yeah, so when we talked a month ago, we were not only talking about the technical, like seasonal factors and liquidity there and kind of the vanna-charm flows, event vol, et cetera, but we were part of the case for why there was likely to be a rally was also because, inflation was likely, we were likely to get some type of some good news from cyclical inflation. And that's why we're talking about a pause by the Fed. And that's why we were getting some of that communication, which seemed to, point in this direction. And we got those. That's what we got in CPI. It was kind of not a huge surprise, I guess I would say, in the sense that, yes, it was a surprise relative to expectations. But the fact that would be possibly or likely coming was not out of the blue. So that CPI print, plays into this cyclical kind of rally. The question is the market getting ahead of itself now, right? A 7.7 print, in the context of an 8% or so expectation, when a lot of these things are lags. Again, I'd like to point back to history. If you look at the 1970s, we had, 3 major recessions. It was still a very inflationary period throughout, 65 to 85, right? For 20 years, we had runaway inflation. It's important not to miss the forest from the trees. And just to give you historical context, I'm actually looking at the numbers here as I'm sitting, inflation in 1969 went from, 6%, 6.5%, call it, all the way down to 3%, right? Into that initial shallow recession. The Fed funds rate at that time, the way that they were able to accomplish that, to put it in context, this is William McChesney Martin as Fed governor, Fed chairman. They took the Fed funds rate from 3.5%, 4%, all the way up to 10%. So put that in context of what we're seeing now and what's happening now. I mean, we took the Fed funds rate from 0 to, 4%, call it, right? It's far cry from that amount of, and the recession that we had in 69, 70, et cetera, was shallow. Was enough to bring down inflation, like I said, from 6 to 3, call it. But that was just the beginning of a much bigger secular inflationary push. The responses to that recession, there was a lot of fiscal responses to it. And we're likely to continue to see that. We're already seeing that as things are slowing down, right? And that's part of, along with other structural things that are happening underneath the hood, that's part of what we believe is likely to continue to push inflation. Important to note, despite having a broad inflationary push that we've seen, we've actually done it in the context of a Fed that's been able to increase the value of the dollar significantly. We have been able here in the US to export inflation. And we've been able to do that partially because there has been a much bigger slowdown outside of the US, which has cyclical disinflationary effects. China shutting down. I mean, that's a pretty dramatic thing. Obviously, what we're seeing in Europe with, some of the supply side, issues, yes, that's inflationary, but the economies are slowing down abroad dramatically. And have been slow. So we've been able to export some of that inflation with a stronger dollar. That's meant commodities have actually not exploded to the upside. But yes, regionally specific areas, gas, et cetera, we know what's going on there. But broadly, as a bigger story, CPI has, cyclically been able to be more controlled. The dollar coming down, ironically, is actually going to import inflation back to the US, and is also, with China reopening at the same time, which I don't think is a coincidence, but we can get to that later, is also going to drive more of that kind of that inflation that's been a little bit hemmed in on commodities, we believe a bit higher. So there's a lot of things here. You can look at the trees and just miss the forest and what's broadly happening. There have been some things, ironically, that have actually been very helpful in fighting this inflationary story, despite how bad it's been. That have been tailwinds for controlling it, which now the Fed, even though we're going into a cyclical period, will be battling against. And I just think it's important to understand history. I mentioned that 69 to 70 period, similar thing with Arthur Burns, 73 through 75. Inflation went from 3 all the way up to 11%, right? Pretty amazing if you think about it. And then we went into a deep recession, much the deepest since the Great Depression, right, at the time. And eventually, the Fed funds rate, dropped from where they had, what caused that was increasing Fed funds rate up to 14%, right, all the way back up from 4, as we mentioned, after it declined. Which again, these are crazy numbers when you think about what we're going through now, and everybody thinks the Fed is being so active, is so aggressive. And that pulled all the way back during that recession to 5%. But again, the key is the floor kept going up. And during those times, you better believe everybody was like, it's over. We've beat inflation. Look, it's inflation's down from 14% to 5%. We have accomplished, and then more to go, 20%, right? And again, everybody wags their finger at Arthur Burns and says, you didn't do enough. But like what we've done in the context of what's going on now is far from, quote unquote, enough. Far from what Arthur Burns did. And so, we can talk about Volcker all day long. But anyway, I'll get off that soapbox. But I think it's important to understand that construct and what's happening, to not get lost in the cyclical in the context of the secular, and to look at the bigger pressures at work here.
Yeah, no, absolutely. Now, you also mentioned a point that we should touch on today, and that is kind of different trends from different asset classes during secular inflationary periods. And I think maybe you've also done some work on that. You already kind of touched a little bit on it when you mentioned gold that might do better. But are there other asset classes you want to have a little
Yeah, we have a newsletter that I did a presentation actually out in Miami at the EQ Derivatives Conference that was talked about this a bit, and we're working on a newsletter to dive in a little bit more on it. But, we've been looking at equities, domestic here, S&P 500 as a proxy, bonds, 10-year as a proxy, oil, gold, the dollar, just kind of these five broad, there's a lot more we could look at, but asset classes and how they perform during a secularly inflationary period. There's no implied vol kind of to look at. But really just what is the personality of how these different assets move during these broad secular periods? The short term and the medium term and the long term, how much mean reversion is there? How much short-term volatility is there? How much long-term volatility is there? How is it biased, right? And so we did a broad study on that. And, I could probably take a couple hours just talking about this, but I'll give you kind of a broad overview, because I think it's important to think about, if we are in that period, what's going to win secularly. Obviously, the last 40 years, if you got the 60-40 part right on stocks and bonds, you crushed and outperformed dramatically for a long period of time. You've done very well. So getting those broad themes right, even though year to year, day to day may not be the answer, can make for a huge opportunity. So yeah, and I'll just give a quick summary. Again, we'll dive into this and other things. I'm sure you'll hear from me in other places, but equities, despite first order effects, which is inflation makes assets nominally go higher, right? We know, and we've talked about this, but during that last inflationary period and during inflationary periods broadly, due to second order effects, which are kind of the effects of inflation on flows, ironically markets go down or have less of an upside drift, I should say, during these periods. We've talked about this, which is it's counterintuitive because of those first order effects. You would think if anything, 8 to 10 to 12% inflation would lead to more upside drift in a nominal asset. But as we've talked about, 65 to 82 or 67 to 82, you look at that period, market went nowhere in nominal terms, lost 70% of its value. We've talked about that. But that's true for inflationary periods broadly on a rolling basis. So upside drift comes down, which ironically drops volatility because there's a lot of realized volatility to the upside over longer periods of time. On top of that, important to note, it actually reduces downside volatility too, because you do have those first order effects as the market comes down. And this is over longer timeframes. I want to be clear, not on shorter timeframes, on longer timeframes. We'll talk about the shorter, but over longer timeframes, it reduces downside volatility because those first order effects make markets significantly cheaper as they go down because of not only, again, 8, 10, whatever percent inflation per year compounded over long periods of time, just takes you out of, makes things, the cash flows alone, it puts a put on the business, on the market, but also because generally these periods of inflation are demand push economics. And so revenue actually does quite well, 67 to 82. I want to be clear, everybody's talking about recession and all that. They're playing yesterday's secular story, but 67 to 82, market went nowhere, but the economy did very well. GDP growth was above trend in real terms during an inflationary period. In real terms, I want to reiterate that, outperformed what we've experienced recently a demand push economy actually drives higher GDP. And so, that also, that earnings, the growth over periods of time also puts a put on the market. So those first order effects broadly do cushion declines more during inflationary periods, those first order effects. Second order effects obviously are, and I can go into all of them, but the value of money goes up. There's just less money to invest, and across assets, not just stocks, but across assets. That's a second order effect. So demand for investment goes down. Reverse Tina effect. So yields go up. All of a sudden, less money going to equities. We've had this Tina effect. All of a sudden, nobody's talking about the reverse Tina effect, which is, bonds have gone from 0 to 5. Guess what? A lot of people say, well, you know what? I don't really want to be in equities. I'm going to go get that 5% or, whatever it is and somewhere else. So reverse Tina effect takes money out of equities and moves demand out. Discounted, first thing everybody thinks about when they think is, the discounting of cash flows obviously makes growth stocks and longer term earnings worth less for an equity. So that's just a structural effect. And then another one that nobody really talks much about is when there's less liquidity, interest rates go higher, there's less money out there, there's less liquidity, not just to buy assets, but to provide liquidity. And that tends to lead to more short-term volatility, right? Even though we're talking about long-term vol being on a realized basis being more compressed, risk premia increase during these periods because people can't take the same risk because there's just not enough liquidity, not enough money to absorb risk. That Fed put is gone, right? That means that there's going to be more general volatility, more risk premia. So those risk premia effects really broadly increase the risk of trading, which reduces people's willingness to commit assets, commit as much money as well on a risk-adjusted basis. So I can go on. There's a little bit more, but these are all second-order effects to inflation. They're not the first order, but they are more powerful ultimately, as we've seen historically, to equity, reducing equity demand. And ironically, a reduction in equities over the long period, given these first order effects, decreases long-term volatility.
So I have a follow-up question on that.
Please.
But I have also two observations before that. One is, of course, and I don't know if you caught this, Stanley Druckenmiller's interview recently on CNBC, where he kind of talked about that his expectation was that equities over the next 10 years probably won't do much from here. They will do a lot in between, but maybe 10 years from now, we're going to be looking at more or less the same levels of equity. So I don't know if that's your view.
I'm not going to toot my horn, but I am a little bit. We were probably a year out in front of Druckenmiller, but having him on your side is a great. Yeah. It's a great person. Yeah.
Although I will say
what you've been saying for a year. Yes, that's where we're going, and in my opinion, and it's great to have other brilliant minds in the space, that have seen a lot of this and are big picture thinkers be on the same page. And I think he very much is. We don't agree on everything, but there's a lot of what he's saying now that, we've been saying for some time and that I completely agree with.
Yeah. Although a little bit of a warning here, Jim, the crypto space also got very cheerful when they had Druckenmiller on their side like a year ago. But that's a different story. By the way, the reverse Tina effect, we could name it ANIT. I mean, that's just Tina in reverse. So I'm not sure it's going to catch on, but we could.
Yeah, that's not as catchy.
But that's not very attractive.
That's like an Indian name, I think.
Yeah, absolutely.
I don't know, yeah.
Anyways, my real question comes when you talk about these things about how short-term volatility might increase, longer-term volatility might compress. And as everybody can tell, I'm not a vol expert here. But does it change the way you trade volatility? And the reason I ask is, of course, because volatility, at least in my mind, is a relatively new phenomenon for investors, meaning institutional flows has not really participated in it very long. And of course, the VIX is only 18 years old. And so it spent most of its time in a secular environment where interest rates were coming down all the time. So just kind of, curious about how you think this might be different, perhaps, for the vol space.
Yeah, to be clear, we have puts were created in 1977. That's when they were created by the SIBO. They were not actively traded till mid 80s, really. So we have no real implied volatility data from an inflationary period. So I cannot sit here and tell you what the risk premium on these things is going to do relative to realized. I can give you broad conjecture, and we're trying to do some of that analysis. It's difficult, right? You have to kind of go with what you know about market structure and think more qualitatively about these things. But to be clear, risk premia, as I mentioned, does tend to go up during these periods. So I can talk about realized, I can talk about broad trends about realized, but the point here is there's less liquidity, which means more opportunity, right? If you're willing to be somebody who warehouses risk. And when you start looking at long-term trends, that represents some bigger long-term opportunities. If the long end of vol, I think it's important to note, is truly contained, right? If again, I'm talking 3 years, 6 years, 10 years out, right? We start talking about really long-term vol. That's a huge benefit. Liquidity is the least in those things. And if you can, there's always this core part to trading vol where, much like kind of trading the yield curve, where there's an upward tends to be an upward slope, a contango, right, to the vol surface. And because of the amount of vega in things in the risk premia further out, particularly to the downside, you tend to those are again theoretically great things to sell in order to own other shorter dated vol mechanisms. And if you have an ability to use those things to own vol, right, there's just people can hedge much more easily, and that will. The point is, the thing that really blew up the vol market in 2008 and during other periods in recent history is long-term vol exploding, because people can always roll their puts further out and use premia and do things to kind of to manage positions. But when long-term vol really starts blowing out, it's illiquid. There's a reason long-term is in the long-term capital management. Like when that stuff starts blowing out, particularly puts out of the money, longer dated, those are things people sell willy-nilly. Just Warren Buffett does it. I mean, it's a long-term kind of profitable strategy, right? If you can size it appropriately and deal with it. So people can manage those, sell those, buy near dated, do other things to use long-term vol, whether it's calls or puts. Broadly, vol manages over kind of shorter to medium timeframes to not get too out of control. Doesn't mean it's not going higher in the short term. Doesn't mean you can't have a liquidation and get a real vol event in the short term. You can and will get short-term liquidations. Okay. But broadly, if you can do that, it stops vol from going into some secular tailspin that can, similar to 2008, again, people don't really know this, but in 2008, 10-year vol spiked to 60. I mean, it was very liquid and wasn't there for long, but that's a crazy number for 10-year vol. I mean, that's not crazy. That's just not crazy. That's insane. I mean, but it went there because of how high vol was for how long and how much, short interest there was in that stuff to push it. That was just caused broad liquidation. So my point is that where long vol is and broad trends to the supply and demand of it, how untethered that can become is critical to the feedback loop for vol in the markets, and more than people understand. So that dynamic between calendars and long vol versus short vol is an important dynamic. So to answer your question again, without giving specific trades, like, if you can lean on that a bit, maybe it's not perfect, but lean on a bit like long vol is, you'll get enough mean reversion, it'll come back, and markets ultimately, in these type of environments, because of that inflationary push, will provide some level of support, some level of long-term mean reversion, and dampen the upside as well. That provides opportunities. So it does change the approach. It makes managing a vol position, particularly from the short side, more manageable for a lot of vol managers. And there's a reason to believe. And again, I started to talk about these trends. We talked about one S&P. There's like bonds. There's gold. But in SM equity in particular, yes, cyclically, I believe there's a great opportunity coming for long vol. We've talked about that based on skew and other thing. We'll dive into that a bit later, I think. But longer term, there is some truth and reason why some of these dynamics that we're seeing are happening based on a more long-term projection of what happens during inflationary periods, like this flattening of skew, the underperformance of vol, even despite vol being a bit elevated here. Like you could make an argument, a very strong argument, that if we are truly in a secular inflationary period, that's actually logical, on a more longer-term time frame. And again, important to not confuse that for short term.
I do want to talk about skew because it's very low at the moment, and it doesn't mean necessarily that we break lower. But before we go there, you mentioned all these other asset classes. As far as I remember, at the moment you focus on the equity space, right? But do you ever feel tempted to kind of say, wouldn't it be nice if I could just expand my wings and dive into volatility in other asset classes?
Yeah, all the time. In my personal portfolio, I do. There's a reason we focus, because we're very systematic on the equity space. That was where we were a big market maker, one of the biggest during the great financial crisis. And that's where we have models that we know are robust and profitable. And there's a certain amount of, when you have an edge, you start there and go with the low-hanging fruit. There's no reason to overcomplicate things. But yes, I mean, I think my macro interests and broader picture, which are go above and beyond some of the systematic stuff. So we are actually in conversations, and I'll leave it at that, to do a more a global macro vol product, because we do have an edge there, and I think we've proven it through kind of all these conversations over the last several years. And I think there's a real opportunity there. It's a different product. It's a different type of thing, and it has it's more of a long-term kind of macro view, and taking those bets and the edge we have on the vol side to express it. Whereas a lot of our other products are, and again, I won't talk about the products too much here, but like are much more short time frames, systematic kind of opportunities.
You should structure it as a private equity fund, Cem, with 10-year lockup. Then you kind of have your playground sorted out. Anyways,
yeah, absolutely.
back to the program, as they say. All right, skew, it's low. It's very low. Talk about that, what this means, and maybe also kind of how this has affected perhaps volatility funds in general this year, in a sense that vol is not performing. I mean, interestingly enough, and again, I'm saying this as an outsider, right? But it just seems to me that like vol maybe in the last month or two have started to react a little bit more like it used to do than while in the beginning of the year it was, felt different. But I mean, you're going to correct me, I'm sure, but that's just how I see it. But anyway.
Yeah, I mean, we talked about this last month a bit, and I've talked about it elsewhere, but just to kind of review, in January and before, skew, when we talk about skew, downside options versus in the equity vol space broadly is what I'm referring to. Downside options versus upside options. Skew was actually in the 98th to 100th percentile, at the highs. That often is the case. The higher markets go, there tends to be more hedging and more demand, especially if times have been placid for some time. But this was really significant, and the flows driving that were fairly dramatic and significant. And I guess that's not a surprise, right? We had, if you think about it, Feb March 2020 was a massive vol event. Entities who did hedge had incredible payouts, and anybody who was short got blown out during that time. And we've talked about these cycles and how these things ebb and flow. So there was significant and again, it's not just psychological, right? It's also just quite simply those entities who buy vol are around and are getting inflows, so they buy more vol, and vice versa. So it's simple math. But it's psychological as well. Mom and pops were buying puts there too to hedge. And so, not surprisingly, you get a decline, which was relatively expected, right? The Fed was trying to make sure people understood what was likely going to happen, and obviously we had some surprises. But the point is, people were hedged, market went down, and people with those hedges who are long stock. Long puts, think of it just in a very simple term, now need to monetize their hedges. They're losing money on their stock and they need to sell their puts. And at first they're like, well, this is just getting started. I'm not going to sell them. But then, the flow of selling comes in, these puts, which maybe were up enough, somewhat to cover some of their losses, but maybe an underperformance where people are like, oh, well, it's just getting started. It's going to be worse. Now all of a sudden they start collapsing, and now you have stock, which you're losing money on, and your puts are no longer hedging your longs. And people get a little nervous and start selling more. And now there's a avalanche of just selling puts, and it's counterintuitive, but with the market down, if people own those puts and that's their only thing to protect them and it's not performing, now you get panic. You get a complete kind of, I got to get out of these things. Like my mandate is such that this is supposed to hedge me. It's not. And we've talked about the long vol managers who are not just hedging their shorts, but like they have to make money in that scenario. And if they start losing, not only do they get redemptions and it's just plain math, but they lose 10%, they have 10% less, and they need to sell 10% of what they have. And so it was just a reflexive loop. And importantly, and I've talked about this before, the more vol selling that happens, it's not just bad for the implied performance, right? Clearly, but it actually affects the realized performance of the underlying. And that's because somebody's got to buy those options. There's a tidal wave of options, and somebody's warehousing them. That's market makers, that's banks, that's dealers in all forms. And they're willing to buy it because they think it's cheap enough and they can trade it and they can hedge it and work out of it. But, as we know, that as we saw in 2017, which was the lowest realized volatility in history by 30%, which you talked about, that selling starts getting, and it really pins realized vol. And that's what we've seen. To the downside, realized vol has just collapsed. We get these short-term moves and then vol gets crushed and the market, goes sideways for, a month and then it rallies back. And so it's been a very non-volatile, in short term, you get some realized moves, but, for the most part, vol has been very, very contained. And more importantly, implied vol has had negative demand, has had, every time market goes down, vol and puts get decimated in the market. This so far this year. And that's brought skew from the 98th to 100th percentile to the 0 percentile. I want to be clear, not like 1%, not 2%. We are at historically the lowest skew that I've ever experienced and that the data sets have in the equity indexes. It's essentially flat. The idea that we're in some really, risky environment with potential World War III and all the things that you and I talk about all the time, yet downside protection is the cheapest it's ever been is notable. It's interesting, right? And again, there's some of the inflationary things that I talked about in an inflationary environment, but we're not there. Valuations are still very high relative to history, and there's a lot of tail risks obviously out there. It's important to note that once you get this broad liquidation and people have given up on puts, and now there are sellers of puts out there who are marketing their returns as a hedge to, this is non-correlated returns. Look at how great we've been doing into this decline. That brings a lot of money in to people who think that, well, this is actually a good non-correlated way to make money. Now, again, we mentioned just like any other strategy, there's, if it's sized properly and done in the right way, like there might be a case for it at the right size. But people get out over their skis. There's not enough liquidity in the space to sort that. Now that, my point is now the cycle's turning the other way. And we saw this 15 versus 16, vol event, non-vol event, early 18 volpocalypse, late 18 vol collapse and a decline, March 2020, now into recent, we get this cyclical performance of vol, implied vol reaction. And it really is a matter of people crowding in and crowding out. We've seen a lot of other types of strategies, but there's a reflexive effect, which is really that as it moves, it can really unpin the whole market and cause really deleterious effects for the underlying asset. I said this in another pod, I forget where I was talking about it, but implied vol in the S&P has been the little Dutch boy with his finger in the dike, right? Holding back where vol has increased elsewhere, which is, FX, bonds, commodities, pretty much everywhere else. And it's kind of pinned and tethered. It's held back kind of this really this big liquidation. We're at a point now where the Dutch boy is weak at the knees. He's been standing there too long, and cracks are showing up in the dike, and so I don't it's hard to say when, but we've gone from a room full of pillows where something happens and you fall down and you're cushioned to a room with gasoline on the floor. And I think that's an important distinction. Doesn't mean the room's going to catch on fire. It doesn't mean that something's going to blow up tomorrow. But things are getting more dangerous, and that's not just because skew is flat and the potential energy of it going higher is dramatic. Markets have been more contained, so valuations are still high, and the more we rally back as a function of this complacency, the more potential energy there is on a realized basis. Those are the basic things, but again, as a cyclical, as a circular reflexive effect, once you move big enough, once those things start to move in a meaningful way, the effect can be big enough where you can really wash out and force people back into buying vol in a meaningful way. And being forced to hedge, and that can cause itself a tail event, as we saw Feb to March of 2020. Again, we talked about the day after Feb expiration ended, the day after March expiration. When you're in these situations, people are not as well hedged, especially in the context of a world where any macro thing can be unexpected and happen. It's a dangerous situation. Again, I'm not calling for a crash. We deal with these things, as I mentioned, in probabilities. That tail is just getting fatter, and you got to be aware of that. You got to be thoughtful of that. And if you're looking at the last year and saying, "Oh no, I can't take these vol losses anymore, get me out," which is what's happening with, whether it's Artemis we talked about last month and in Chris Cole's long vol product, other products, because just the losses have been too difficult and the performance has been so bad. The more we see of that, the more it's coming. The positive performance is coming on the horizon, but it always takes a bit longer than you think, because again, people hold on and then eventually give up at the worst time. So I don't think we're here yet. I've been saying that for some time. I think it's early to mid to maybe even late next year. We'll see. Again, Q1 is what we were initially kind of thinking here, but we'll see, and that can get pushed out. It generally does take a bit longer than you think, but the market environment has changed on a cyclical basis. I want to be clear.
Exactly. And I think you were saying, when you told the story about the little Dutch boy with the finger in the dike, that actually he was not only getting tired, he wanted to get home to his mother to get some cookies.
Exactly.
That's how I remember your conversation with Grant and Bill. It was with Grant and Bill that you talked about this story. Now, this is just kind of an outside-the-box question that just comes to mind, and I don't know if it's a good one or a bad one, but, I remember back in 2018 when we had Volmageddon, we had the disappearance of XIV. And that kind of structurally, as far as I recall from listening to vol experts, that kind of changed the dynamic of the market. Suddenly you had a very big player that were used to doing one thing and had a pretty big market share, and it kind of changed things. This time around, do you see a change in the market structure from certain types of players, let's call them that, leaving the market, and does it go back to? I know we say this is not. With skew in the 0th percentile, it's not happened before, at least not in your career. But can we say anything about how long these periods last for before things go back to more normalcy? Or
yeah. Again, we do believe, as I mentioned, that we're in a different regime than we've been in, or that we're entering a different regime. And then, take that in the context of also these cyclical things, which are functions of human nature that tend to repeat. And you got to kind of reconcile those two things. So history, we're not going to repeat history in the same way because we're in a different regime. And that's why I kind of referred to some of those long-term trends and things that might be different. That said, the human nature part is important. Supply and demand is critical in the short term, in particular, right, to outcomes. So I guess to answer your question, like in terms of, I guess, timing it, in terms of thinking.
Not so much that, but I was just curious whether these things, like, in certain situations, and we talk about in the trend following world. I mean, trends don't last forever. You have certain, trends, they last for a few months and then they take a pause and then they come back and so on and so forth. And I don't know if there's anything similar in your world, or maybe we're in fact still seeing so many things that hasn't happened before where we just say, well, we don't actually know.
Things that you can broadly rely on, like as a broad trend, that's true throughout history and vol. It's an insurance product, right? Like after the tornado comes through town, insurance premia go up, and it's a great time to invest in tornado insurance, right? It doesn't mean at that moment it's a sale, right? But I think if you then take that in the context of regime change and things that might be vol dampening, there might be an interesting vol selling opportunity broadly coming up. That said, that in the context of that, we have this cyclical kind of red flag for something that's going to, again, cyclically likely happen in our view. And so, I think that's all you can lean on, right? Is what you have structurally, what you have cyclically. These are all affecting one another, and then deal with human nature and trends in markets and why things happen. And the context of, hey, this is how this be different, and take that into consideration as well. And I guess that's kind of our broad approach. So that's all you can do. There's obviously lots of uncertainty about all these things. That's why there's opportunity. Again, you have to lean on, you have to have conviction somewhere to make money broadly. I don't think if you don't have conviction, you don't, an opinion for a reason. Part of our conviction has been on the secular story of inflation. We've been out in front of that. I continue to believe that. All the time, we're looking for contrary evidence all the time. I've yet to see any. If anything, reinforcing evidence keeps coming. So that, now putting that in the context of vol is something that we're using to our benefit while still understanding what's happened and being deep in market structure for the last 30 years or so. Gives us, if that doesn't change, what other things are just generally things that are part of human nature and how microstructure works.
Sure. Now, the last point before we wind down for today, and again, I don't know whether you feel we've actually already covered it. That's perfectly fine. But we did write down a note about liquidity and volatility, especially in the context of bonds and what they've been doing. Because as I said in my introduction about an hour ago, I mean, a lot of the market action at the moment is just driven by expectations to interest rates. I mean, that if every time there's someone out talking about it, or we have a number that might or might not change the direction or the pace of interest rates, then markets move. So have we done enough on this for today, Jim, or is there any final thoughts?
There's an interesting thing to circle back on here, which is related. I've talked about risk premia and liquidity and kind of referred to how risk premia goes up during periods of inflation. Not necessarily realize vol itself, but the risk premia should. Again, we don't have as much evidence on the implied vol in particular, but there's just less liquidity, so there's less ability to absorb risk, right? If you have less players in inflationary periods to absorb, let's say, insurance, right? You're just going to have higher premia, and so. We broadly believe that those risk premia go up, which is an opportunity, right? It's good for insurers. It increases their risk as well. That's part of why that risk premia goes up. But it is an opportunity. And if we now circle back to some of these inflationary period dynamics with some of the other assets, we talked about S&P 500, but I'd like to pull in kind of oil and the dollar as kind of two of the examples we can talk about. We kind of referred to gold early, but those two I think speak to what happens during inflation periods, speak to liquidity. Right now, vol for both of those things has gone up dramatically. And the question is that warranted? And how are they similar? Both oil and the dollar, we talked about first order effects, they're a store of wealth, right, during a inflationary period, and benefit from first order effects of flight to safety. Not to mention the kind of the related effects of, as we talked about in other episodes, when you have inflationary periods, you tend to go into a period of competition and more geopolitical strife, more protectionism, more fear of the not having safety and assets. So both of those have benefited historically during inflationary periods. They both have upside drift over the long term, unlike the periods of non-inflationary periods in nominal terms. But liquidity, if you think about it, for the dollar, actually goes down because the Fed has less control. They're dealing with their dual mandate. So whereas controlling that dollar price, same with bonds, right? Controlling, and bonds are a great example. Bond vol was dramatically compressed. The Fed has essentially had the bond market cornered, and anybody who traded Eurodollar options or anything like that, basically that market died. There was zero vol, incredibly impressed because of liquidity, dramatic liquidity during that time. As the Fed put comes off the table, Dixie bonds, vol actually structurally goes higher. And again, it's because they're now battling a dual mandate, where they can't just come in and do monetary policy whenever they want. It's stagflationary. They're kind of in a box, right? And that releases vol broadly. So that's less about direction, but vol becomes higher reflexively because implied vol becomes unpinned and risk premia go up. I'm going to contrast those to oil. Oil, ironically, has been less pinned because there hasn't been one dominant force been able to control oil. We had a Fed put, but we didn't really have an OPEC put or anything along those lines for some time. Much more kind of a two-sided market, as we've seen, right? Oil went to -30 and it went to, 180, right, over this period. We've had a pretty crazy ride. That has driven recently vol much higher in the commodity market, oil in particular. I don't think many people are looking at the short side in energy and commodity vol. There is a OPEC put developing, a very strong one that we believe is structural, really, in this period of a period of broad resource scarcity. In a period of competition, those entities are going to flex their muscles more. They're going to have more power in this environment, as we've seen. And we believe that, ironically, even though that's scary, even though that may make people want to demand vol for the assets, we actually believe, and history says this is true as well, that vol, ironically, compresses for commodities because that downside gets cut off. The U.S. has already announced that they're going to refill the SPR at $72. If that's not a put on oil, I don't know what is. And we believe this is broadly structural and that OPEC will defend price. And it'll be two-sided. If it gets to a point where it's going to cause worldwide recession, that's not good for them either. So much like the Fed, they are going to be in there trying to control the volatility of oil, broadly make it go higher, which is good for them. And so we will get upside drift, as we believe, but with compressed volatility. So that ends up looking a lot more like equities, right, from a vol perspective, what we've seen in equities for some time. So we think that's an interesting takeaway. And that is really, I know you asked the question of liquidity, but that's a function of the ultimate source of liquidity changing. Yes, the Fed will still be involved. They'll have less control over liquidity. In the commodity space, there's a new kind of put out there, which I think is important to talk about.
The Russians might say the put is in, but they pronounce it Putin. But there we are.
I like that. There you go.
All right, let's
like
leave it. Let's leave it at that, Cem. Thanks for Thanks for spending some of your Friday with us and sharing all of these thoughts. For those of you who enjoy these conversations, please head over to iTunes, Spotify, Amazon, wherever you listen to your podcast. Leave a rating and review. It certainly helps other people to find us. And make sure you follow Cem on Twitter. There's so much good stuff coming out. Next week, I'm back with Mark, and so there will be a chance to tackle some of your questions that relates to what he's up to. So you can, of course, as always, send them to info@toptradersunplugged.com. From Cem and me, thanks ever so much for listening, and we look forward to being back with you next week. Until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.